If you weren't aware, the success of your financial future and any financial plan you build rests solely on your shoulders. Gone are the days of working for a company for 20 or 30 years and then receiving a pension and some social security and being able to live a retirement that we all dream of living. To put yourself in a position to retire and actually be able to enjoy your retirement, you are going to need to grow your wealth. The easiest way to do this, and the most easily accessible for the majority of people, is to invest their money into stocks and bonds. Now, you could get lucky and pick the next viral cryptocurrency or any other obscure investment. But I personally would like you to keep your investments simple. Keeping them simple and investing in the things that you understand are what's going to keep you on track over the long term. In this video, we're going to get into what stocks and bonds are, the very basics of investing, and how you can use a very simple approach to grow your wealth. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And when it comes to building your wealth, the greatest tool that you possess is compounding interest. Now, to understand what compound interest is, Ben Franklin broke it down as follows. It's money that makes money, and the money that's made makes even more money. And as odd as that may sound, it's not as complicated as it may seem. If we start with $100 invested and we receive a 7% annual rate of return on that investment, then at the end of year one, we would have $107 in our account. In year two, assuming we receive the same 7% rate of return, we would end that year with $114.49. The compounding interest is that 49 cent that you see on the end. Although it doesn't seem like a lot, that 49 cent adds up. At the end of 10 years, if you start with $100 invested and receive a 7% annual rate of return, you're going to have over $196 in your investment account. So over those 10 years, you made $96 and did nothing. You put your initial $100 in and you watched it grow over the course of those 10 years. And that's the beauty of compound interest. So how are we going to gain access to this compounding interest? Well, we're going to invest. And one of the first things we're going to look at investing in are stocks. And with a stock, you gain ownership in a company. So if we take ABC Inc., for instance, and they decide to issue stock to raise money for whatever project they want to raise money for, you can purchase those stocks that are issued and gain ownership of that company. Now, one thing you need to keep in mind when it comes to owning stocks is that you can lose your entire investment. If a company goes belly up or they have to file for bankruptcy, then you can lose the entire amount of money that you invest. And that's one of the risks of owning stocks. That's the biggest risk of owning stock. But because you are willing to take on the risk of losing all of your money, the returns you receive from owning stocks are typically larger than other safe investments. Speaking of safer investments, the other type of investment we're going to look at are bonds. And what a bond is it's an ownership stake in the debt of an institution. Typically, you would think of bonds as something that comes from the US government or the Treasury. And the purpose of these bonds is to raise money for operations or whatever they need to spend that money on. But bonds are typically going to come with interest payments. And the purpose of those interest payments are to compensate you for taking the risk of lending that institution money. It's very similar to you going to the bank and borrowing money to purchase a home. If a bank is willing to give you $300,000 or $400,000 to purchase your home, they're going to want to be compensated for taking that risk. The way they get compensated is through the interest that they collect from you. So with bonds, you do receive interest payments, and this does make them a little bit safer than stocks. The other thing that makes bonds safer than stocks is that creditors get paid first in the event of bankruptcy. If you're a shareholder or you own stock of the company, you're last in line when it comes to getting paid. But if you own the debt of that company, then you get moved closer to the front, if not the front, of getting paid in the event that that company needs to liquidate. Because of all of these safeguards, the return on bonds is typically lower than that of stocks. And that's all due to the risk-reward scenario. The less risk that you're taking on, the less reward you're going to receive. So now that we have a basic understanding of what a stock is and what a bond is, we need to get into the stuff that you actually came here to see. And that's how did those asset classes perform over a long period of time. Well, if you were invested 100% in the S&P 500 since 1987, your average rate of return would have been 10.8%. And this is a very good rate of return, especially over a 37-year time frame. But to prove to you that stocks are more risky and more volatile than bonds, we have to look at the maximum drawdown. The max drawdown for stocks was 51%, and this happened during the Great Recession, or the 2007 to the beginning of 2009 timeframe. And what this means is that anyone that was invested 100% in stocks at that time lost over 50% of their account balance. And this creates a lot of heartache for a lot of people, especially if you've saved up a significant amount of money. And this is what you have to keep in mind when it comes to investing in stocks. There are major ups and major downs being invested in those assets. Now, the second piece of this are the bonds. And if you were invested 100% in bonds over the exact same time frame, so January of 1987 through May of 2024, your average rate of return would have been 5%. No, it's not near as pretty as the 10.8% you would have received in stocks, but it is a much less volatile asset. That 5% that you would have received over those 37 years is much more stable than that of the stocks. To give you an example of how compounding interest works, we can look at what these portfolios would have done since 1987. If you would have started with $10,000 in 1987, invested 100% in stocks, you would have $465,399 in your investment account. And the reason that $10,000 grew by so much was due to the 10.8% compounding. Now, if we look at what the bonds would have done over that same time frame with the same $10,000 invested, your account balance would have been $62,421 as of May of 2024. And this is due to that 5% compounding each and every year. And this is what we mean by that risk-reward scenario. The more risk that you're willing to take on, the greater the reward is going to be. The less risk, the less reward. And this is proven by the numbers. So the 100% stock portfolio was able to help you amass $465,000 in your invested accounts. The problem with the path to that $465,000 is the path has a lot of bumps in it. The blue line that you see on your screen is what that 100% stock portfolio has done over the past 37 years. We can see the dot-com bust in the early 2000s and then the subsequent recovery. We can then see the Great Recession, or that 51% loss that you would have experienced had you been 100% in stocks at that time. And then after that, we see the recovery all the way up to the pandemic, which there was a small drop and then it recovered quite quickly. And then all the way up to the present day where you have the $465,000 in your account. Now with bonds, that path is a little more smooth than being 100% in stocks. The green line that you see on your screen are the bonds. And being 100% in bonds over this period of time was much smoother than being 100% in stocks. And again, this has to do with those interest payments and the fact that creditors get the first crack in a bankruptcy filing. So with the bonds, you have less volatility, you have less return, but you also have less heartache. So all the way through to May of 2024, your path being 100% in bonds was much smoother than being 100% in stocks. Now, the way that you can use these two together are through what's known as diversification. And the purpose of diversification is to help smooth out your path to building wealth. Now, you have to keep in mind, the more you diversify, the less return you're going to receive. So instead of being 100% in stocks, if you reduce that down to 50% and the other 50% was in bonds, then the rate of return you're going to receive is not going to be 10.8. It's going to be something less than that, which we're going to get into in a second. But as you get older, as you start adding members to your family, you need to consider diversification. Being 100% in stocks, especially as you get closer to retirement, is not the greatest of ideas. You need to smooth out that path. And the reason this is not only to preserve your wealth, especially as you get closer to retirement, but to also keep you from making any knee-jerk reactions to what the market is doing. If you would have been 100% in stocks when the Great Recession started, you most likely would have sold at the bottom of that 51% loss, because that's human nature. That's how things time out. For the majority of people, they're going to buy high and sell low. It's the exact opposite of what you want to do when it comes to investing. So the easiest way to keep yourself from making a decision that could lock in a significant loss is to diversify your accounts. So if we were to add a 50-50 portfolio to this graph, where 50% of the money that you have is invested in stocks and 50% is invested in bonds, that line should fall in between the 100% stocks and 100% bond portfolio. And that's actually what you can see on your screen. The gray line on this graph is that 50-50 portfolio. And it's right in the middle of both of those 100% portfolios. And the beauty of diversifying your accounts into whatever asset allocation fits your risk tolerance is that it smooths out your wealth building journey. You don't have to deal with the severe ups and downs of being 100% in stocks, but you can also gain a little bit more growth than being 100% in bonds. And we can actually see the returns of this portfolio at the top of your screen. So over the course of 37 years, a 50-50 portfolio would have grown $10,000 into $195,000, or an average rate of return of 8.26%. And this is a very good rate of return. In retirement, we're targeting 7%, and that's just to keep the 4% rule in play. So a 50-50 portfolio over the last 37 years has returned just over 8%. And this is how diversification works. It takes some of the risk off of the table by getting some of your money out of stocks and into safer investments. You do this at the expense of growth. Compared to the 100% stock portfolio, you've lost 2.6% on an annual basis, and that ultimately costs you $270,000 over 37 years. But you didn't have to deal with those severe ups and downs that could have caused a knee-jerk reaction. So depending on what your risk tolerance is, you need to determine how much of your money you can stand to be at risk or be invested in stocks. The rest of that money needs to be invested in bonds. Now, I want you to keep in mind, it is very difficult to grow your wealth without some level of risk. Yes, you can be 100% in bonds and be safe, but the problem is your 10,000 would have only turned into 62,000 over 37 years. If 5% as your average annual rate of return isn't going to get you where you need to be, then you're going to have to either save more so that way you can hit your financial goals, or you're going to have to introduce risk to experience the growth that you need to experience. Now, I want you to keep in mind that this is the very basics of investing. There are many other asset classes that you could add to this example. You could add gold, you could add commodities, you could add real estate, you could add anything to these portfolios and maybe make them better. But when it comes to the majority of people and what they have available to them to begin building their wealth, stocks and bonds is where you have to start. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that's just getting started on their wealth building journey and they're not sure what they should do next or where they should even begin investing their money, then send this video to them. Maybe it'll help get them on the right path. But I want to thank you so much for tuning in. I'll talk to you soon.